Interest rates are on the move again. How will the bonds in your portfolio respond to the latest interest rate news? This is Jeff McDermott from Create Wealth Financial Planning, and I'm going to talk to you a little bit about how the bonds in your portfolio might be reacting to some of the interest rate changes we've seen and that we're expecting. No matter how aggressive or conservative of an investor you are, you probably have some amount of bonds in that portfolio. And interest rates have been big news for several years, really from the unprecedented zero interest rate policy after the Great Recession and the mortgage boom that followed, to one of the fastest rate rises in decades in 2020, which led to the worst return year for bonds in 50 years. Now it's rates coming back down a little bit, it looks like. The Federal Reserve just cut the federal funds rate by a quarter of a point this past September 17, 2025, a couple of days ago. And again, that's going to affect the bond funds you hold in your investments. Bonds have two elements that produce return that can grow or sometimes reduce your investment. The big one most of us probably think of is the interest yield that a bond pays. See, a bond is a loan from you, the investor, to the government or a company or a local municipality. And in exchange for that loan, they pay you interest, usually twice a year, based on the interest rates of when that bond was issued. That determines what's called the coupon rate, which is what you receive in interest. So a lowering of interest rates means that future bonds may pay less interest when they're issued versus bonds that were issued over the last couple of years. That's bad for people looking to purchase bonds and live off of that income. But the other element is the actual value of the bond itself, what the bond is worth. And that also gets affected by changes in interest rates. If you own a mutual fund that's a pool of bonds, that value is going to be affected as well. For people that already own bonds, now the bonds they have are most likely a little more valuable because they may have been issued when interest rates were higher. They pay out a higher interest rate, and all other things being equal, new bonds you buy now are going to be paying lower interest rates. How that works, it's helpful to envision a teeter-totter or a seesaw. Again, as bond prices decline, the value of existing bonds goes up. This is one of the first graphics they show everybody when they start to learn about bonds and personal finance. And we can think through an example to help out. Let's say you purchased a U.S. Treasury bond and it was paying 4.5%. But now new U.S. Treasury bonds are being issued and they're only paying 4%. Your 4.5% bond pays more interest each year than the 4% bond. So for the market to value those bonds equally, you should be able to sell your 4.5% bond for more than the new 4% bond. The value of your bond has gone up. Now the opposite's true if interest rates go up and you're holding a bond at 4.5% and new bonds are at 5%, your existing bond may lose a little bit of value. We saw that again in 2020 in a major way. But the positive of those interest rate rises is that individuals looking to buy and hold bonds for income get a chance to purchase bonds that have higher yields. Even if you saw money in like a high yield savings account, you saw that jump in interest rates over the last couple of years. That's because interest rates across the board went up. Now there's lots of factors that go into the pricing and the value of bonds. Things like credit history of the company, how long the bond has until maturity, the tax treatment of the bond. But there's an unbreakable relationship between the value of the bond and changes in interest rates. Now again, your portfolio might have a range of different kinds of bonds, and it's important to realize not all bonds may respond to this change equally. The Federal Reserve sets short-term interest rates. They actually adjust something called the federal funds rate, which is the overnight rate that charges banks to lend money to it overnight. That's a very short-term interest rate, but it still drives decision-making and drives rates across the board. If we look at a picture of the yield curve today, what we're seeing is the interest rate on different time periods of money. Short-term, medium-term, longer-term. And this is a partially inverted yield curve. What we mean when we say that is what you would expect is the longer the money is lent out, the longer the term of the bond, the higher the interest rate would be. But we're seeing an inversion where short rates are higher than intermediate rates. That's sort of 1 to 5 year window. And then 10, 20, 30-year bonds are back on the higher end of the range. So it's not a smooth curve, it's a curve with a bend in it. This represents an expectation from the market that rates will continue to come down and normalize, but this curve can be out of balance for a while. It has been for a little while now. And different points of this curve may move at different speeds or may respond differently to those interest rate changes. It may not be uniform across the board. As short-term rates come down, those short-term bonds should increase in value. But at the middle point here, rates are already lower. We may not see a whole lot of movement based on an interest rate drop. Things are just kind of getting back to normal. On the higher end of the curve out here, you may see some rates come down, but again, they're probably not going to drop past what those intermediate rates are, at least in a normal world. That's the expectation. So you're going to see some different things happen based on different bonds. Hopefully your portfolio has a wide range of different kinds of bonds, different timelines for those bonds, different times to maturity. So you get a variety of responses and you're not isolated to just one sort of part of that yield curve. At the end of the day, make sure the proportions of bond you hold in your portfolio is proper relative to the level of risk that you want to take in that portfolio. Don't try to time the market or base your investment solely on a guess of where you think interest rates are going to go. The big picture is how much stock and how much bonds you have, and that should fit your financial plan. If you have questions about that, questions about your own portfolio, questions about bonds and interest rates, please reach out. Happy to discuss with you. And thanks again for watching this video.